Hey everyone, welcome back. Today, we're diving into something I'm really excited about, our September 2025 edition of 3 stocks on sale. Now, if you've been following me, you know the drill. Every month, I handpick 3 stocks that have recently taken a hit in the market but look compelling from a long-term investment standpoint. Here's what makes this series different: I structure it to cover 3 levels of risk. You'll get, I want to make this more than just a list of tickers. We'll dig into market trends, company fundamentals, industry insights, macroeconomic factors, dividend opportunities, and growth drivers. By the end, you'll have a thorough understanding of why these companies are trading where they are today, and why they might be worth considering for your portfolio. Now, before we jump in, remember, this is educational content, not financial advice. I encourage you to do your own research, evaluate your risk tolerance, and make decisions that fit your financial goals. Alright, with that out of the way, let's kick things off with our low-risk pick. Our low-risk pick this month is Extra Space Storage, ticker symbol EXR. For long-term investors seeking stability, a reliable dividend, and exposure to a resilient real estate sector, EXR has been consistently one of my favorite choices. You might have heard of Vici Properties, another strong REIT, but right now, EXR stands out because of its valuation gap. The stock has dropped nearly 40% from its highs, yet the underlying business remains strong, offering a rare opportunity for capital appreciation combined with dividend income. Self-storage is an often overlooked segment of the real estate market, but it's historically one of the most resilient. Over the past 20 years, self-storage rates have generated the second highest returns among real estate sectors, trailing only data centers, which have surged due to demand driven by artificial intelligence and cloud computing. Compare that to other sectors. Self-storage, however, is recession-resistant. During the Great Recession, the 2020 pandemic, and even today's environment of high inflation and interest rates, demand for storage units continues to rise. In fact, the percentage of US households renting storage units has reached an all-time high, demonstrating consistent consumer demand. EXR stands out in the self-storage sector because of its market dominance and operational excellence. Self-storage has inherent advantages over other real estate sectors. EXR offers a low-risk entry with attractive dividend yield and long-term growth potential. Even if the market remains volatile, the company's operational resilience and market leadership make it one of the safer bets in real estate today. Next, we move to a medium-risk pick, Bristol Squibb, BMY. For investors seeking a combination of high dividend yield and potential recovery growth, BMY presents an interesting opportunity. Like EXR, BMY has recently experienced a significant decline, over 40% from its highs. This drop has pushed its dividend yield above 5%, offering income potential while the company works through some internal challenges. BMY faces one of the steepest patent cliffs in the biotech sector. Key drugs such as Eliquis, blood thinner, and Opdivo cancer therapy are either losing patent protection or will by 2028. Analysts project revenue declines over the next 3 years due to these expirations. Additionally, last year's EPS turned negative, driven partly by one-time charges from the $14 billion Contrarian Pharmaceutical's acquisition, which caused market panic. Despite these challenges, large, established pharmaceutical companies like BMY typically recover after downturns. Here's why: BMY is medium risk because of patent expirations and temporary revenue pressure. However, its high dividend yield, strong pipeline, and historical ability to rebound make it an attractive long-term hold. Stock number 3, The Trade Desk, TTD. Our high-risk pick this month is The Trade Desk, TTD. If you haven't heard of them, TTD is a digital advertising powerhouse that operates a cloud-based demand-side platform, DSP. Think of it as Wall Street for advertising. Brands and ad agencies bid in real time for digital ad space across websites, mobile apps, streaming services, TV, and audio platforms. During the pandemic, as the world became increasingly digital, TTD became a favorite for advertisers trying to reach consumers online efficiently. Their stock reflected this surge. Revenues grew over 20% in 2020, 40% in 2021, and 30% in 2022, and over 20% annually in the past 2 years. But now, the stock faces a combination of slowing growth, competitive pressures, and structural market challenges, which has led to a price drop of more than 60% from its highs. Despite this, TTD is still up over 1,000% in the last decade, highlighting the long-term potential for investors willing to endure volatility. TTD's core business is centered on programmatic advertising. This model allows advertisers transparency and precision, but also creates exposure to what analysts call walled gardens. These are ecosystems where dominant tech companies control all the data and inventory. If these platforms decide to withhold access or compete directly, it can limit TTD's market reach. TTD is proactively addressing these challenges. TTD is high risk because of, however, it offers high reward potential if. For investors comfortable with volatility, this could be an attractive opportunity to invest at depressed levels with long-term upside. To summarize, no matter your risk appetite, each of these stocks illustrates the importance of thorough research, understanding industry dynamics, and assessing both macro and micro factors before investing.